Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to discuss two key topics. Obviously our favorite, the Primary Vision Frac Spread Count, but also we're going to look at Iraq and what's happening in terms of demand and kind of where's that supply coming, because they were supposed to cut. But first, before we dive in, we really want to touch on some of the things that we've really kind of created and broken out. So the Primary Vision Network, we now have a Wednesday show, which we've had for a couple weeks now with the EIA update, Thursday with the economy show, and at times we'll have an OPEC Plus show or a special update, and then obviously our favorite show on Friday, the Frac Spread Count. So now that we've gone through some of those things, our producer Colin was kind enough to add a new chart today, so we get to look at the Primary Vision Frac Spread Count in a new light, which we can all shout out to him for creating such fantastic charts. So here you can see just kind of really jumping in, the Frac Spread Count came in at 76. Now, just to kind of think about where we were, where we're going, last week when we were at 80, we said that we were going to start to kind of pull back a little bit and really kind of hone in on this, let's call it 73 to 75 4-week rolling average. And we're kind of in that confidence range. And when you think about why, we really have to consider kind of where is the activity shifting, how are things moving around. So in August of last year, you can see we're at 366, which is obviously something that we really don't think we're getting back to, at least in the next 24 to 36 months. But the big thing that we want to really kind of look at when we're looking at this nice, pretty new chart is comparing that 2019 to 2020. So typically in August, and you can kind of see that how we typically have a decline. And we're just not going to see that this year just because of the adjustments of COVID and people trying to start to get back to work to kind of kick off Q3 as they have a little bit of money to spend to try to offset some of those decline curves. But again, we're going to kind of hang within this range that which we continue to talk about. And it's good to kind of look at the last 3 months, and you can kind of see how we started to kind of level off after we had that big drop. And now we're going to kind of sit within this tight component, just really driven by the Permian. The Permian's going to continue to get a little bit more activity, going to see a little bit more love as we go through August, but we're going to see some different adjustments where these one-offs coming on for a week or two, doing a completion that might have been done on spot or just gotten a good deal on, or maybe it's part of a smaller program that's being rolled out over the course of a month. So that's where we're going to get these one-offs, but we're really going to kind of stay now between the 75, 85 range, and we really should kind of hold along that 75 on that average. And the reason why we're looking at this and thinking, okay, well, what's activity going to look like? Chevron had an interesting chart today during their earnings report where they talked about the Midland and Delaware Basin and where they see monthly production now going forward. In the past, there was a view of this rapid growth, things were going to increase. And last year, we were very adamant about the fact that exit 2020 was going to be below exit 2019. And the view was just we had saturated the market with light sweet crude. There just wasn't enough capacity in the world really to handle this kind of product. The U.S. refiners, as we showed last week, we really need heavier crude. So what we were producing, still a large part of it had to get exported. And now we're starting to see that come to light. Now, this chart doesn't include the purchase with Noble. So once you start factoring in Noble and Chevron, you're going to start to see some of these reductions. And as we've talked about in the past, we're going to see a continuation of mergers, acquisitions, bankruptcies. So you're going to naturally get this tightness. You're going to naturally get this reduction in overall production, but you should start to get some efficiencies. Chevron obviously owns its own refiners, Petchem. They have the ability to sell on a global level. So there's a certain amount of efficiencies that they can gain just by increasing their vertical integration. And we're going to continue to see that as we get this consolidation, trying to get these economies of scale. But at the same time, you're gonna rationalize frac spreads. If Noble's running, let's just say 5 and Chevron's running 10, well, do I really need 15 as a combined entity, or do I need 8, or is it 12? It's going to be some adjustment. So you're just going to see this tightness continue to roll into the market. And when we think about going forward, why do we feel confident in the fact that we're not going to see this massive increase in, outside of pricing? The reason why is the prices are going to remain capped. And the reason why they're going to be capped and really kind of drift to the downside is because we're starting to see with the oversupply in the market really come to light on the pricing side, which we've been talking about. The physical market has really started to flip into a contango. You're starting to see discounts kind of roll through, Urals, as we've talked about, West Africa. This chart just looks at the Dubai swaps, really kind of thinking about, okay, well, where are people pricing? What does the benchmark look like? And you can see we had a quick spike into backwardation where things were positive. You'd want to sell the front month. And now we're starting to see that softness come back into the market. You're starting to see spot discounts. You're starting to see, people really kind of hold off on some of these purchases, which is where we're seeing that flip into contango, which just means that you'd rather store it and sell it at a later date. And that this is something that is starting to increase across not only just the Middle East, but Europe and Asia. But we really want to talk about Iraq because Iraq was they had cheated. They were going to make up for cheating. So here you can see the production that they have. And then the red line is where they should have been producing based on the OPEC plus agreement. So they should have been between 3.59, 3.6 in terms of, whose math you want to use. But again, it's in this range. So here you can see that they've continued to produce above that because they were supposed to be at that 3.59 May, June, and July. And clearly they were above that level in May. And then they were above it in June, but they were supposed to get closer to making it up in July. And in order to meet these demands, the country was going to make additional cuts: 70,000 in July, 314,000 a day in August, and 313,000 in September. Now you can say, okay, well, how are we going to know until they actually report? Well, this is why we look at exports, and when we look at exports, you can see what they were exporting versus what they were producing. So in May, they exported 3.57, in June 3.26. And remember, in June, they were still non-compliant. Now in July, they're actually exporting slightly more versus June. So is it because they're just consuming less oil? So even though on a production level, they're meeting the OPEC plus agreement and they're just exporting more? Or are they just still producing above what they said they were going to do, and they're just putting the additional into the open market? It's probably a mixture of both, just because they have their own issues with Hezbollah. You've seen different attacks. We have economic issues, like in our economy show and EIA shows, we've talked about OPEC and the issues with the economies overall, specifically Saudi Arabia. So if Saudi's feeling pain, obviously Iraq is as well. So people just may not be doing as much. So there's less consumption of oil internally, which allows additional crude to go onto the market. Or are they just continuing to produce well above where they promised? I would say it's a mixture of both. But again, this is something that's going to play out over time. And when we think about, well, why does it matter that Iraq continues to overproduce? And it's because of these discounts we're starting to see. So Asian refiners, just kind of looking at Asia now, because this is a chart that we had shown a few weeks ago, looking at the super tankers going to China. We had this big spike, and now the declines are really starting to set in. The number that are heading to China are decreasing. And this isn't a big thing because you're saying, oh, well, maybe those tankers are going somewhere else. No, the tankers just aren't going anywhere. And it's one thing where, the Asian refiners didn't pick up any Ural crude cargoes for July loading. So this is a bigger issue because you're starting to see, okay, well, Ural prices spiked, so maybe they didn't want Urals and they went elsewhere. And they did. They went and they got these super tankers from the Middle East. But now that we're past this level, we're getting towards the end, and we talked about the glut that's been formed off the Chinese coast. You're just not seeing the demand. You're starting to see this really drop off, which is creating this issue in the market, which is why you're starting to see these price discounts. And the reason why is, again, this one is a chart that we've seen before. China continues to slow down. There continues to be pressure across their economic indicators, daily activity, industrial levels. And when we take this and we say, okay, well, China kind of flatlined, things have started to slow down. Well, let's look at just traffic. Let's look at congestion. You can see that it's really starting to slow down, and we got back to a little bit of this normalization, and now we're starting to dip down below where we were in 2019. And this is something that we believe is where they've already dipped down, and it's only going to get worse as we have new COVID cases increasing. And we have additional problems when we talk about Three Gorges Dam and the Yangtze River Basin and just the economic corridor that's created. So we decided to create a separate show, just a special update on the Three Gorges Dam and what does it mean for flooding, and not just to wear a tinfoil hat and think, oh, this dam's definitely going to collapse, but what does it mean for the Chinese economy when we consider the massive amount of flooding that's happened above and below the Three Gorges Dam? And these are things that are going to continue to weigh on the Chinese economy, which is something that we're going to go into a bit more detail in terms of what is the fallout. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Have a great weekend.